Good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in the market. We've had a little bit of technical difficulty with getting started today, but hopefully everyone can hear us and you're all able to join. Now, when I look at the flow of research from BI over the last week and what's ahead, two things come to mind. First is that this is our last call before the COP26 meeting in Glasgow, which kicks off at the end of the month. And just last week, we had the IEA's World Energy Outlook published, always a great document to flip through. And so I think the way I would characterize things is that, here we are in the midst of a commodity rally. The revenge of the old economy, as Jeff Curry at Goldman Sachs likes to call it. And we've got rising fossil fuel prices, and we've got policymakers basically begging for industry to do the opposite, use less fuels, that kind of thing. So I really want to start the conversation off today with a broad question and have everyone on the group weigh in. And it's, which world should an oil company or gas company or utility being start preparing for? Are we in a world where we have rising fossil demand, strong energy commodity prices? Are we in a more net zero world? How do you play this if you're the management team at an oil company? So we're going to start with Salih. We'll go to you first, then Will, then Patricio.
Sure. Sorry. Thanks, Rob. I think, and we did have the IEA report last week as well, the World Energy Outlook, and what they tend to do is give us a couple of scenarios to look at, and I think this is the approach that the oil companies are taking as well. And when we look at it, we do have, on the extreme ends, we have the net zero scenario where we really ramp up the low carbon energy investments, and in this world, demand starts to go down. Again, this is one extreme side of the equation, and then the other one, we do have kind of almost going backward in the pledges that the countries make and the companies make in terms of their emissions. I think in reality we will be somewhere in between, but to the management of these companies, I think slowly you will have to kind of shift strategy so that you are ready for more towards a net zero world, which is the NZE scenario that IEA says. And I think I should point out that it does depend on what type of oil company you are. I think what we'll see, especially out of COP26, is probably more pledges being made, more near-term pledges being made, and in reaction to that, over time, some of the international oil majors kind of pulling forward some of their emission targets. So if you're an international oil company, I think the writing is on the wall. And what they've already started doing is kind of have more of their capital spending geared towards green energies. But then again, for national oil companies, it's a different story. I think the way the Aramcos and the ADNOCs of the world are looking at this is that as international oil majors shift spending and focus away from upstream into more green energies, they do see this market share that's there for them to grab. And they also see a world where if demand is more resilient than imagined in some of these scenarios, we could be living in an undersupplied world. So I think they do see it as their responsibility to increase spending and kind of make sure we're not too undersupplied if demand really does prove to be resilient. But I should say, I do give the example of Aramco and ADNOC because these are the companies that we already know are planning to increase their spending, and they can increase their spending because they're relatively advanced economies. If we live in a world where undersupply is an issue, it's important to note that not all OPEC countries, not all NOCs will be in a position to increase spending to fill in any gaps. So I think if you're management in any of these companies, it does depend on which type of companies you are. But I think gradually they will have to reckon with a world that's moving towards the net zero scenario that the IEA told us about.
Will, is there a big difference for an integrated oil company based in Europe or the West generally? Are they thinking about this conundrum or problem in a very different way than how Salih just described it?
Yeah, so I think my answer would be a general continuation of where Salih was going with his. It really depends on what kind of company and in which subsector of the energy ecosystem that these companies are operating in. They will have very, very different strategies and outlooks. And I think just as a good example, you can take a look at the European oil majors and see how quickly their tone has changed around emissions and energy transition in the last few years. We're now looking at about 15 to 20% of total annual capex being deployed into clean tech, renewables, or transition businesses for these companies. But then you can really contrast that with say the independent North Sea E&P companies. These companies are much less flexible. They're much smaller. They don't have the same access to capital. They don't have the expertise and the ability to diversify into some of these sectors. And so I think what we're seeing here is a strategy from these companies to essentially keep the wolf at the door for as long as possible. Keep in mind that E&P's primary strategic objective is to maximize recovery of hydrocarbons. Clearly, at some point, that is going to be a difficult strategic endeavor to pursue indefinitely, and particularly in the UK North Sea, where volumes have entered terminal decline, and we think certainly by 2050, but maybe even earlier, we could see marginal to no volumes produced on the UK continental shelf. So there are very varying approaches, I think, to how to plan for the future for these companies. Clearly, the majors are, as Salih said, see the writing on the wall and it's green. But then other companies do not have the same ability and willingness in some cases to do a full 180 on their strategy to prepare for the future. So they're kind of all in on oil in some select cases.
Patricio, let's hand it over to you. Does the gas side of the narrative look different? Obviously, one question that might come to mind on the gas side is, how long is the bridge fuel? Gas is often cited as the low carbon cousin of coal and other fossil fuels. So does it have a strong role to play over the next 5 to 10 years as you see it, particularly given the run up in prices we've seen?
So in terms of how this would impact utilities, at least in Europe and in the West in general, is we've seen companies just increasingly pushing towards renewables, sort of cutting all the capex plans for gas, at least in Europe mostly. So we do see sort of a gaining traction for renewables accelerating into the end of this decade. But the recent energy crunch in Europe definitely raises questions about trying to mitigate the commodity price exposure to this volatility of external shocks from supply-demand fundamentals, especially. Just this weekend, actually today and tomorrow, the EU Commission is meeting to design a toolbox to try and prevent further shocks to the energy prices in Europe. But going through the motions of looking at what the alternatives are, there is not much that the Commission can do that would not actually put the continent at odds with the growing push for renewables. We don't see companies revamping their investments in natural gas, at least not in continental Europe. We may see a bit of regulation for storage, which is currently not very much looked at. And The other side of the equation would probably be some sort of extension of the lifeline on nuclear, perhaps, but we do not see a return of natural gas. And then this sort of percolates well with IEA's report, which sees natural gas demand sort of taper off from 2025 onwards, which seems pretty dramatic given the recent events and sort of the demand. I think demand for natural gas tends to be a bit less elastic than oil, especially when you're about to enter the winter season here in Europe.
Thank you, Patricio. One of the things that's caught my mind just broadly amid the commodity run-up is the idea that the oil price has rallied, let's say 66% this year roughly, but the equity performance of producing companies generally has lagged that. It hasn't kept a pace. So I'd be curious to hear, particularly from Will and Salih, how do you reconcile that difference? Do investors in the producing companies maybe not believe the rally is sustainable for the long run? Is it other parts of their business that are feeding into it? I know both of you have written previews for what we're going to hear as companies announce their 3Q results. So, how do you interpret what's going on in the oil market side with where the companies stand at the moment? So we'll start with you, Salih.
Sure, thanks, Rob. So, I mean, when we look at the larger oil majors, they do tend to have what we call oil beta, which is how their performance is linked to the oil price that is below 1. And this is partly because they seem to be giants with different kind of sectors that act as a natural hedge. So most of the oil majors produce oil, but they also refine oil, which doesn't do as well when, for example, oil prices go up. So, and beyond that, they do have other sectors that play into this. But to your point, I think also partly it is because there is this huge rally in commodities and in oil prices, but there is still a lot of concerns and worries about what these companies will look like in the long term. So I think there's certainly that energy transition discount, if you want to call it that, in the sense that I think there are increasingly investors that are worried about kind of getting back into the sector, which may kind of keep kind of the performance of these companies in check, even when oil prices are at above $80 a barrel, which is way above their break-even prices. And I think when we talk about oil prices as well, when you look at the curve, it is very much back at 70 or below at the end of next year. So I mean, these prices are great for them, and you did mention, and I'm happy to talk about this in a minute as well, about what to expect in the third quarter. But what we have seen so far is almost every quarter has been good, with just better and better benchmark hydrocarbon pricing. On the refining side, that has been relatively subdued in the first half, but what we are seeing so far is margins are looking very good for the third quarter and into the fourth quarter. So, I mean, things are looking up for them. Things are good, but especially the larger integrated companies just don't tend to move as much as the oil price. And I should say, and I think Will can talk about this a lot more, but compared to the integrators, I think if you look at the companies that focus on E&P only, on oil production only, and perhaps the servicers as well, that would move a lot more closely with oil prices.
Yeah, Will, let's get you to weigh in. How do you interpret the current market dynamic? Which names are most levered to the oil prices as you look at the companies you cover?
Yeah, so I think the one area that I'd just add on to Sally's answer, which I thought was very good, is that I think the average generalist investor has sort of faded from the investor base of many of these companies, I think, and I think the key part there is the sustainability risk that Salih mentioned, is that the average investor, I think, now looks at an oil and gas producer as a riskier investment than historically, given talks of reaching peak global demand, of the necessity for achieving net zero emissions, and of course increasing evidence of more dramatic climate change and weather events occurring. So I definitely think that is a major part in this trend. And I think something interesting is also occurring as a result of this, because we're seeing many of these companies that aren't trading at historical multiples that they were, despite a very constructive pricing backdrop. What we're seeing is that management teams are de-emphasizing growth and investment, and instead deploying that capital towards shareholder return measures. So we're seeing a lot more focus on buybacks, less so on dividends, but that as well. And so I think we will continue to see this, because if this this trend continues, where the generalist investor remains skeptical of being an exposure to oil and gas, we will see this elevated cash flow, which we are seeing right now across the space, from oil majors down to E&Ps and refiners, be deployed into other areas to augment the share price if the investors won't bid it up themselves.
Does that imply higher dividend yields as you look into the future? Is that one way that you see this potentially playing out, Will?
So I think dividends are recovering, and that's quite clear. But for at least the European oil majors, they're taking a much more cautious approach on dividends. Dividends aren't something that these companies take very lightly. For instance, up until Shell's cut last year, it's 67% cut. It had not cut its dividend since World War II. So the dividend reliability, payout sustainability is seen as a key sort of investment case differentiator for these companies. And so I think they will be very gradual in recovering their dividends. We've seen some of this occur already, but instead the buyback policies can afford to be much more volatile, and they can move around much more. Management can deploy them, the scale and the timing at their discretion, give or take. And just for example, we're going to see BP report roughly $1.4 billion in buybacks in the third quarter. They report in early November, and this will be the highest number of buybacks they've ever made. And we're seeing a very high level of buybacks as well across the rest of the group. Total as well. Shell's increasing its buybacks, and we're seeing some gradual, marginal, and careful dividend recovery alongside.
Will, I want to get your thought on just the idea of natural gas and how it feeds into the narrative that you're seeing for integrated oil majors. Many have made big investments there. Do you think that the gas rally is something that offers a potential win in the near term for some of the players that have taken LNG investments and other things on the gas side of the equation?
Yeah, certainly. I mean, of course, when you have spot pricing jump to record highs, you have the producers of that commodity that will benefit. Although obviously not all of their production is spot. It's usually having spot exposure. It's usually a minority. But yeah, all of these companies, the European oil majors, and to a lesser degree the oil-weighted North Sea E&Ps. Are benefiting from this, but I think, to be clear, the strategy and investment behind the larger companies occurs on a multi-year time frame, and so their LNG investments are advancing regardless of what happens in the spot market. All of them have signaled and outlined that LNG is for all except Equinor is a core component of their long-term strategy, which they have almost entirely seen as being a sort of defensive mechanism against the prospect of peak oil in the future. They're all becoming more gassy in their production mix. There's many large LNG mega projects underway, and this is to meet anticipated gas demand in the future. So yes, gas is it will be a key part for cash flow growth in 3Q, and it will be an increasingly bigger part of their portfolios and weightings moving forward.
Patricio, with that idea in mind, I want to swing back around to you. So obviously the gas run up, great if you're a producer, but I think it's causing a lot of heartache and heartburn for the consumers here in Europe in particular, for some of the lawmakers. So what do you mentioned the EU is formulating a toolkit for how to address the run-up in gas prices. What do you think the likely response is going to be? We're going to see more wind and solar, and what's the timeline look like for bringing on any of these responses? And just the kicker of a question too is, is the run-up driven by overzealous investment in green energy, or are other factors at play? So a lot to unpack there, but let's hand it over to Pat to get some thoughts.
Sure. Let's try to break that down. First, in the time scale of things, we don't see a lot that European lawmakers can do in the short term to alleviate the power price crunch, other than proposals to temporarily reduce taxes and levies on power prices. There's not much else you can do. One highlight was Spain's proposal to claw back windfall profits for the companies benefiting from the surge in natural gas prices, but that has been supported a lot of backlash and is being dialed back somewhat, so that it sort of meets what other EU members are doing. And this may result in some sort of introduction of a tariff cap, at least for the zero marginal cost production like hydro or nuclear. That may offer some reprieve to power prices in the short term, but longer term, we do see European lawmakers just doubling down on renewable capacity growth. They've been really outspoken that what they want to do is shorten their dependency on fossil fuels, especially considering that Europe imports 90% of its gas, and nearly half of it comes from Russia, which has been a political adversary for ages now. And so that's the view on the short term and the long term view in terms of the energy crunch. And finally, the last question, I do think it's a contentious question between people who are sort of more supportive of fossil fuels versus renewable advocates. I do believe that the power price crunch was just a convolution of supply-demand fundamentals, and it would be very hard and perhaps erroneous to try and pinpoint if this is a matter of underinvestment in fossil fuels and overinvestment in renewables. It seems more like this is a pickup in demand after a pandemic, and this was sort of an unprecedented situation where demand recovered sharply and unevenly across the globe, and we've been underinvested in the whole ecosystem due to the pandemic for the past year and a half. So that might sort of explain why we have this demand-supply imbalance, but I don't want to take sides on that renewable fossil fuel front at this time.
Fair enough. No sides are required. Salih, I want to come around to you on this idea as well. If you look at the IEA's World Energy Outlook, they had a really compelling chart that we highlighted in one of our notes this week. And at least in their net zero scenario, they estimate that the market size for clean energy could exceed the market size for oil by 2030. Now, how they define market size, I think it's volume times price for oil, and then they look at all of the clean equipment spend that could occur annually under a net zero scenario. So yeah, is this something that could actually unfold over the course of the next decade? And if it does, is there going to be continued finger pointing about where we are in the commodity cycle on fossil fuels?
That's a good question, Rob. I mean, will it happen? I don't know. Like I said, this net zero scenario is supposed to be kind of on the extreme side of things, but it is giving us a good idea of what that world would look like. And that scenario essentially envisages that demand for wind and solar would rise by as much as 4 times by 2030 versus the current levels. And as you said, the clean energy market would by then be bigger in dollar terms than the oil market. And that suggests a CAGR of about 15% to 2030. And it would take wind and solar capacity to more than 1,000 gigawatts, which is significant. So, I mean, I think the tone of this whole report was that, yes, this should happen, or something like this should happen. We should be moving towards this scenario. But at the same time, they did say, this is something that they didn't say in the previous report, but did in this one, is that at the same time, investment in fossil fuel industry should increase as well. And if you look at all 3 scenarios, and on the other end of the spectrum is a scenario where oil demand just keeps growing until after 2030. But even in that one, of course, fossil fuel investment would almost double. But even the net zero one, they see oil investment into fossil fuels increasing by about 10%, and that's for the time period of 2022 to 2030 every year. So I think what they were warning about was that if we don't invest more in both clean energies and fossil fuels, that more of what we're seeing right now, which are turbulent times, as they call it, and kind of mismatch between demand and supply that Patricio was talking about as well, that could just become something that we see more often, and the kind of these supply and demand shocks could be something that happens a lot more frequently. Again, will we be in that net zero scenario that they're seeing? Probably not, because this is a scenario where oil demand is just falling from the current levels, which we are seeing isn't proving to be the case. But I think we are probably somewhere in the middle scenario, and I would guess that we slowly but surely move towards the net zero scenario that they're talking about in their World Energy Outlook.
Thank you, Salih. Very interesting discussion as always. Just a quick highlight. Everything we talked about you can find on BI Go. If you're following our research, you can read the previews that we write on all the companies we cover by running EEGO on your terminal. After the earnings are out, we put an outlook out. So we take into account what we just heard and put out a view on what we think is going to happen next. So watch for those previews and outlooks as we go through the earnings cycle. We also refresh the primers on all the companies we cover every 90 days. You can find them by typing BECO. And if you're not in our client chat, many of you are, I think, but if you're not there, reach out to any one of us on the call. We're happy to get you added. There's always discussion, not just from us, but from other folks who are in the broad energy community who want to talk about all the kinds of things we've discussed here today. So reach out, and we are always happy to talk to you. Have a great rest of your week. We'll hold the next one of these on the first Wednesday of November. Have a great afternoon, everyone.